the market's going up despite maybe lack of catalyst or despite maybe great headlines. And so can it keep doing that?
We have the potential for that money to move out of cash and move back into equities. And we actually may be at the start of one of the greatest FOMO trades that we've ever seen.
To protect our economy and our financial markets from catastrophe, what's necessary is to find a consensual, bipartisan approach to raising the debt ceiling.
How this spending bill could impact our finances, how it could impact everyday Americans.
Hello and welcome back to my channel. Everyone is wondering what's happening with the market right now. How will the debt ceiling affect the economy and everyday Americans? And how will it all affect the prices of stocks and cryptocurrencies? In today's video, Raoul Pal has shared his viewpoint on government debt and its impact on asset prices. He has also shared his insight on how to predict the future of the market and economy. To know more details, stay tuned till the end of the video. And if you want to stay up to date with the latest crypto insights, markets, and economy, make sure to hit that subscribe button and the bell icon. All right, are you ready? Let's dive right in.
But what I've kind of unpacked within this is, yes, liquidity, the regular styles of liquidity, but there's the different style of liquidity, which seems to be the Fed balance sheets, that I think is a debasement of currency. So all assets rise versus the denominator, which a lot of people can't get their heads around. And so optically, everything goes up. So I started using a different denominator to look at asset prices. Like the S&P's pretty much gone nowhere since 2012 if you use the balance sheet.
Yep.
In fact, real estate, gold, S&P 500, nowhere. While NASDAQ, crypto, up a lot. You know, with NASDAQ one, crypto the other. Okay, because they're both secular adoption curves of technology. So you can understand why it does it. So that's the difference I've got with liquidity to most, this debasement idea, and that it has a very different, profound impact. In the Everything Code, and I'll send it to you, Darius, because it's like 18 years of work, and I got to, I think it's a thesis, it's a hypothesis, but I think I've got to figure out why it happens, which is, I think it's to do with the monetization of the interest payments of every of the major governments every 3.5 years, which is between the 3-year and 5-year average duration of their debt, which has made the ISM completely cyclical because everybody reset interest rates to zero. We had a global, I only realized this recently when I wrote the article. In fact, after I wrote the article, the global reset everyone's worried about or wanted or thought about happened in 2008 when all rates went to zero, was basically a debt jubilee.
Yeah, it was.
There's no payments at that point. So what's happened since then, the refi of the debt has created this cyclicality. And I figured out, and I'll show you the chart, which I've never shown outside of GMI so far, I'll show it in a minute, is that the interest payments exactly mirror Fed balance sheet growth. And I was like, holy shit, I discovered this by mistake. And I'm like, holy shit. And then it went down the rabbit hole that I then did the same for the UK, Europe, Japan, and they're all the same.
Oh.
So they're all monetizing their interest payments. So that's what ends up in the balance sheet plus any banking crisis, right? So that's the extra delta that adds on top. So then I started looking at it and realizing I think I've got I can look forward on the monetary cycle in this way because we've got forward-looking indicators. Now, are they going to hold all that stuff? Who knows, right? But I think I can look forwards, and I think I can look forwards out till end of 2025. And because of with our weekly liquidity index gives us a 97.5% correlation with the S&P 500, NASDAQ as well, that we can put prices on assets going out to 2025.
Raoul Pal explains how the government prints more money to pay their interest, which makes money worth less and everything else more expensive. You see, they do this every 3.5 years, which matches their average debt time. This makes the economy follow a regular cycle because the interest rates go to zero everywhere. But it also makes their balance sheets bigger because they have more money than they printed. Raoul Pal uses balance sheets instead of dollars to measure prices of things like stocks and cryptocurrencies. This shows him how much things really grow or shrink in value. Let's get into the next clip to hear more from Raoul Pal on this matter.
All the major governments got to 100% of GDP in debt. except Japan, which is 260, whatever it is. So when they get to 100% of GDP in debt, most of their private sectors are about 100% of GDP in debt, more or less. So if interest rates are at 2% and GDP is growing at 2%, I think of GDP growth as your income to service your debts.
It is.
So therefore, the government crowds out all of the private sector just by its interest payments. And in which case, the economy will keep shrinking by the amount that the private sector has to pay. So what they've done is removed the government interest payments. So then you've just got the corporate sector. And that is why, it's one of the reasons why it ends up on the balance sheet, but GDP is slow, because we've got these gigantic interest payments. Because as you know, nobody pays off their debt. They just keep adding to it and refining it, and it keeps going.
Imagine you have a credit card with a high balance. You only pay the minimum amount each month, which barely covers the interest. Your debt keeps growing, and you have less money to spend on other things. That's what happens to most big governments. They owe more money than they make in a year, except for Japan, which owes more than twice as much. When governments are in this situation, their businesses and people are also in debt. If the economy grows at the same rate as the interest rates, the government can barely pay its interest. But that leaves less money for the businesses and people who have to pay their own interest. Governments try to avoid interest by buying their own debt, but this doesn't help much. The economy still suffers. People keep borrowing more. Debt gets worse. The twisted tale of governments drowning in debt, the private sector struggling to stay afloat, and the relentless burden of interest payments. It's a delicate balance that impacts economies far and wide. Before jumping ahead, be sure to like and share.
So we have a financial conditions index, which is based around the rate of change of the dollar, rates, commodities. And that started picking up. This is why we picked up the low. It actually came in June when we picked up the low in Ethereum. And then we confirmed by about October as actual liquidity started changing. So that's when we started getting more aggressive on our technology bets and crypto bets. It has a 5-month lead over global liquidity. So this, and again, this is time horizon. I'm less focused on where we're going in the short term. There could be TGA stuff, whatever. We're not looking for exact matches here. We're like, directionally, what happens? So directionally, this is suggesting, and this indicator has been pretty good for asset price and everything else. I'll come on to that in a sec. The ISM leads it by 15 months. And the reason being, which is weird, is because it's so perfectly cyclical. So each previous cycle looks like the next cycle. So we found that. Now, will this be persistent? I don't know, but I think it will be. So it's suggesting that forward-looking liquidity is going to go significant into 2024.
According to Raoul Pal, the Financial Conditions Index has a mind-blowing 5-month lead over global liquidity. We're not playing around with short-term exact matches here. No. We're all about those directional trends, my friends. And guess what? The trend is pointing in the most glorious direction. Liquidity is set to improve significantly until 2024. Do you agree with Raoul Pal's viewpoint? Let me know your thoughts in the comments below. And don't forget to subscribe to my channel for more updates on crypto and economy. Also, be sure to give a big thumbs up to this video. Thanks for watching, and see you next time. Adios.